you very much for that, George. I know myself that sometimes when we talk about these global issues, people often see these being global issues that aren't actually going to have direct relevance to them. But in the context of the work that we do, clearly the ability of people to access registers and trusts, and particularly private family trusts, and the question about where does transparency and the public interest for transparency start and where does it end, versus the public interest in protecting the most vulnerable. So it's actually a huge issue, something that we've made representations to the Department of Finance in terms to Brussels on in relation to 5AML, and just to I think we can leverage on that opinion to support that.
Yeah, I think that's very sensible.
So our next speakers are Joe McLoughlin and Frank Brennan from Williamson, and the title of their talk is World Gone Mad, Current Economic and Investment Considerations. I understand this is not tour of all of the investment considerations brought about by Brexit, by Trump. Also potential some practical issues today, points that Lisa had in terms of how you structure your portfolio, the different, not alone the global issues. There's so much going on in terms of designing an investment portfolio nowadays. You've got to look at the profile of the individual for who you're actually investing. Are they resident here, are they domiciled here? How does that play in terms of the investment profit? Maybe on a higher level, just to understand some of those issues that are going to drive returns over the past couple of years, you shed some light on that for us.
Thank you, John, for that overview. I better rewrite my speech very quickly. We will touch on a number of those points, but I do hope to keep it fairly bird's eye view. So my name is Joe McLoughlin, as John mentioned. Frank Brennan, my colleague, will talk about investment considerations and how they pertain to today's investor. But I'd like to keep it, as I mentioned, at a fairly bird's eye view of the world, because rather than getting into the nitty-gritty of portfolios and construction and so on, rather what are the driving forces in the world today that are affecting markets and how people invest. We are, apart from speaking today, we are the lead sponsor of the event, and since Williamson's been in Ireland, we've supported and sponsored STEP from the outset, and for even longer, a number of years in the UK, and indeed in a number of STEP jurisdictions around the world. So we're delighted to be continuing to work with STEP, and thanks to John and Ronya for the work behind the scenes, and Cormac Brennan in preparing us for today. Just a quick word on Smith & Williamson. We're not a household name yet, as far as I can tell, in Ireland, but yet we do manage €500 million of Irish wealth here, managed here in Dublin. More assets managed in London and other jurisdictions, but €500 million is not insignificant in this market, and we're delighted to have that level of presence here. There are two things I would say very briefly before moving on to the main topic. One is that I think the management of that wealth here is important, and the local knowledge that is required, which is something that was touched upon earlier in the earlier talks. And secondly, given that we have an international angle to the firm, we have strong competence in non-dom resident but not domiciled individual work, and that coupled with, I guess, local expertise for the local market and international expertise and experience for resident but non-dom individuals, I think places us well for this market. Which is why I enjoyed Lisa and Sasha's talks earlier, because in a way they laid the ground nicely for the types of client situations we can help with. Lisa talked about Fred and Rose as a case study. I was relieved their surname wasn't West, by the way, in moving to Ireland. But Fred and Rose gave a good example of that. The local management is important for Fred, and the local expertise, rather than having a base here and running the money out of London or whatever. And yet, for Rose, the international experience and the non-dom angle came into play. And then I'm sure it was Kevin and Jessica, who Sasha talked about, and their ARF, which again, to be an ARF provider, apart from an investment manager, is important, and it's a service we provide. And there was also very, I thought importantly, the point made by Lisa about the non-brokeraging of accounts outside of the country for the non-dom constituents, and that's very much, given that we're an international firm, the way we operate for being able to place assets outside the country, though they are managed here. Anyway, enough about Smith and Williamson Investment Management. I want to move on to the broader concept of today's talk. The title that I chose, World Gone Mad, that Frank and I agreed upon, really was at that point in time when we were asked for a title in January, February time. It did seem that way. Donald Trump was just entering the White House. He was announcing travel bans for Muslims. He was insulting Angela Merkel. He was accusing China of being a currency manipulator, and this coupled with all sorts of other issues. It did feel as though the world was going a little bit mad. Given that we're now just a few short months later and there's talk about impeachment of the said Donald, it is quite remarkable that isn't really calming down very much. So we thought that would be an interesting angle to take on, not the American angle, but rather just generally how the world is changing and the implications of that for investors. John mentioned a bit about my background, but I've worked and lived in the City of London for the last 20 years, until last year when I relocated family back here. And during most of that time, I have to say that what would broadly be called geopolitics never really entered into my or my peer group's analysis of markets up until recently. So for years, it just wasn't really, not that we were neglectful, but rather it just didn't really affect markets. So whether if you go back to the horrific things like 9/11, well, the markets were back at their high of the 10th of September within 2 weeks. You had the invasion of Iraq in 2003. Markets took off hugely afterwards, defense stocks in particular, for example. We had Clinton not impeached, but there was talk of Clinton. The markets didn't care, they carried on. We have had all sorts of Israel-Palestine related volatility. The markets have just ignored all of this stuff generally, and that's the way it's been for decades, really. But there has been a change, I think, in the tone of things of late, and that's what really brought about this notion, which I think is summarized here well in this sentence, that politics and populism are influencing financial markets more than ever. So whilst people like me may have ignored, not neglectfully, but because they didn't impact, well, you can't do that anymore because they do impact. And I think politics has an impact at two current levels. One is that actually, in terms of mechanically, governments and policymakers, i.e. central banks, are getting involved and starting to, since the financial crisis, influence markets in a mechanical, operational way, i.e. quantitative easing, interest rate policy, and so on. And secondly, there's been an upsurge from a very low base in what's broadly known as populism this last number of years, and that's affecting political outcomes regarding elections and so on, and it too is having an influence. And from those two areas, I thought it would be a bit dry and boring to talk about quantitative easing, especially as just one part of a broader day. It's a bit tedious, to be fair, and we focus on maybe the more interesting subject of geopolitically of the rise of populism in recent years. So, I thought this is also worth addressing, because personally, I find if I ever have to listen to anyone for more than 5 minutes, I ask myself this question: what's in it for me? And if I could just address what's in it for you as an audience, I guess, as trust and estate planners, think about all of the things that we've talked about today thus far. But coming into that mix, of course, when you think about succession and generational planning and the preservation of wealth across generations, is of course the big underlying themes that drive investments. And whilst not perhaps making direct decisions on those, to be alive to them and attuned to them, and aware of specialists who think along those lines. So I would suggest, as professionals, as step professionals, that there is a relevance to the themes that we're going to talk about. So what we might look at is how should governments respond to the rise of populism, and in fact, how have they responded? What are the implications for financial markets as a consequence? And at that point, I'd like to hand over to Frank to talk about basically the global opportunity investment set today, and cover and round out the conversation with that point. So, populism and the rise of populism. Support for the current concerns of ordinary people. Populism in itself is not a problem, but it's rather the causes behind what brings about populism, which can actually create difficulties for governments and economies. it's not the rise of populism. Well, if we think back 10 years, there really wasn't a sense of populism about the place, and I say the place globally. In fact, 10 years ago, people, broadly speaking, wanted to be part of the establishment. They saw a successful establishment through the 90s and 2000s and wanted to be part of it and benefit from it. And things have changed quite dramatically to a point now where, broadly speaking, a lot of people want to rail against the establishment, want to reform the establishment, want to perhaps replace the establishment. So there's been quite a big turnaround from wanting to be part of that perceived wisdom and structure to rallying against it. And that brings around political instability, social unrest, and of course it's not the first time that the world has witnessed a significant rise in populism. The most obvious example in recent world history would have been the 1920s, the roaring 20s, the hugely successful 20s, followed by the 1929 crash, and then the 30s, the depressed 30s, and what happened brought around a rise of populism, which of course ended very badly in 1939 and into the 1940s. So we've seen a strong rise in recent times, and it's to be thought about carefully, I think. I wanted to mention a few the sort of key ingredients behind this and what actually has created this, what I describe as a perfect storm for the emergence of populism. And just a few points. First is what's described often as a large intolerance gap. So after a prolonged period of economic growth and social development, when you have a sharp reversal, as we've seen in this country in 2007 into 2008, but indeed across the globe. So really a situation where people have become accustomed over a very long period of time to a certain standard and find that there's quite a gap between what they have and what they used to have, or what they have and what they would like to have. And there's an intolerance around the emergence and widening of that gap. And certainly that is something that has been witnessed in the last 10 years or so. Extreme inequality. This doesn't just happen when, it happens all the time in the world, but when coming out of a sharp reversal, very often there are benefits to be had and opportunities to be gained. And what happens is they sometimes accrue to the smaller percentage of the population who are best positioned for that. And huge swathes of the population don't feel the benefit from a recovery. And it breeds resentment, and it also creates a sense of desperation if there isn't a social structure in place to protect people in that kind of environment, adding to this intolerance that I talked about. And then also a lack of social mobility, again adding to that same sense of desperation, and rooted really in the education system. If an education system, and this is not, I must say, of all the points on the screen here, this is probably the least applicable to Ireland. But a poor education system whereby people simply cannot get onto the rung of the ladder of social elevation creates that lack of desperation and adds to the rise of populism. And the final point is one that I think is very frequently overlooked in terms of the root causes of populism. Because people see it often as very much a bottom-up thing rather than a top-down. But ease overproduction refers to the fact that you've got global wealth and families emerging over decades, and there's much more of it about. And these people, many of them, having achieved huge wealth, would now like to move on and achieve more power. So there's a competition for the same number of political spaces that were ever there, but there are more people at a powerful, wealthy level, perhaps interested in acquiring those positions of political power, having achieved personal wealth. The same individual we talked about earlier in the US is a good example of it, I guess. And what can tend to happen is that there's a rabble-rousing, jumping on a bandwagon in order to tap into the three other causes that are out there, and basically add to that whole sense of anti-establishment. So those are the four headline reasons, I would say, that have created this sense of populism in the world, around the world. And moving on now to what that means, we're now at this point of the presentation moving more towards the implications of this for the markets and for economies and so on. So how have governments, how have they responded, how should they responded? Broadly, I've outlined two main ways in which governments have responded to this very significant change in the texture of populism. One is termed destructive punishment, which, in fairness, is a pretty evil-sounding concept, but it's actually it's not as evil as it sounds, I guess, but it's really about finding the causes that have brought this about, trying to identify them, and then trying to remove them. And governments have decidedly set about doing this in certain parts of the world. So targeting potentially the elites, but certainly the causes. So just to give a couple of examples of this type of thing, we've heard statements such as Chinese manufacturing has taken all our jobs. And that's particularly American sentiment, but it's also a European one as well. That doesn't blame Chinese manufacturing, as an example. Or this country's got too many immigrants in it, taking our jobs and using our welfare. And these quite sweeping statements, which people like to sort of ascribe blame to for the situation of an economy at any point in time, and going about targeting those. In other words, well, Chinese manufacturing. So globalization has become the villain. Globalization and global trade and the ability to move jobs around the world and so on has become the villain. Immigration has become the villain of those who would seek to punish the causes of this populist move. The UK is quite I think a clear example of how this type of policy is being pursued. In, for example, the Brexit vote, much of it hinged on the immigration issue, and it's unproductive in the end, because when you target the likes of global trade and become isolationists and put up barriers, well, perhaps the richer element of society doesn't get more rich, but no one does. In fact, the general level of productivity falls, and it's damaging for all participants and the economy generally. The other way, I guess, that governments have responded to the rise of populism could be broadly termed as unsustainable growth or unsustainable growth promises. Now, this is classic Donald Trump territory. Here we look at you're looking at basically making promises which, in the short term, deliver results and deliver rewards, but there's no real solid basis behind it that can take it forward. So we're going to create jobs. We're going to build walls and create infrastructure. We're going to deregulate so people can do more what they wish. But the actual upshot of that is damaging to an economy in the long term and quite unhelpful. So whilst the UK perhaps is a good example of destructive punishment, I think the US is a very good example of unsustainable growth, whereby if you do tax less and if you do spend more, someone's going to pay for that, and it's going to be, I guess, the next generation or the generation after that will feel that as the deficits and debts grow. So it is a quite short-term solution to the problem, but yet a remarkably popular one. We've seen that in how the markets have responded to, in the US, for example, to Donald Trump's election. The problem with these approaches is that they don't address the root causes of the problems, as I mentioned. They're really, as I say, short-term fixes, or else trying to kill off the problems which are perceived rather than perhaps the real problems, as I've outlined earlier. I was at a talk last week where a CEO of a global company I thought he described something quite well, and it reminded me of this slide. He said that the problem is like an ice cream cone. If you don't lick it early, it can get very messy. And I think that's quite this is perhaps relevant to the thing here, in that the problems of populism aren't being addressed by simply making promises about creating jobs in the short term, or by saying, well, we're not going to let any more immigrants into the country. It's rather more structural, fundamental issues which generally fail to be addressed. So, ideally, what should be the approach? Well, here the notion of a gradual rebalancing of the economy is the approach. The language is actually softer than in the other terms because it is a more gradual and slower process. And the point here being, perhaps not cutting tax to attract short-term business or whatever, but rather maybe taxing more on high earners, but deploying that capital effectively into affordable and quality education. In other words, producing a generation of people, and it takes a generation, if not more, producing a generation of people who are innovative, who are IT literate, who work in R&D, who can actually take an economy forward, and the implications that that has on the general population are great, obviously. So, in other words, not blaming the fact that the Chinese have taken the jobs, because apart from anything else, in the first place, it wasn't the Chinese, it was the robots that work in those Chinese factories, and robots are everywhere, and automation and technology has resulted in those job losses. In other words, they're not coming back. So successful economies need to rethink things like where they are in the value chain and not be trying to compete for low-level jobs, but rather raise their population higher up the value chain for the future, which takes generations and decades to get right, but it is, that's why I described it gradual, but it is perhaps the right solution to the issues that are faced in the world, around the world at a populist level. And I think it's also worth bearing in mind that there's space for the unsustainable growth bit as well in the short term. In other words, yes, some infrastructure spending and creation of short-term jobs is important because this is a gradual process. But what is missing at the moment is this element of the longer-term improvements in education, etc. And it's all focused on the short term. There's probably room for both. Is the answer, perhaps. There's no real example here. I've got examples, question marks, whereas in the last couple of cases there's some stark examples. And it's difficult to say. I would suggest perhaps Angela Merkel is latching on to some of the policies here more than many, but there's no government which is very starkly adopting this policy, I would suggest, obviously enough, because of democracy and elections and wanting to appease voters. I won't dwell on these points in the interest of time, but I'll just skip to, in terms of the globalization point, just one of the interesting bits here, that because there is an increase around the world in terms of protectionism, potential trade barriers, and there's a lot of concern about developing trade wars, which is bad for everyone. Bad for taxpayers, because someone's got to pay for those subsidies that companies are receiving. Bad for consumers, because they've got to pay more through tariffs. So I just throw that in there as another reason, perhaps, why the anti-globalization theme is a dangerous one. Right. To take it then to the conclusion that I wanted to, which I said at the beginning, which was how this impacts on investing and markets. And again, as STEP professionals, as trust and estate planners, the long-term themes of investing do matter. And while structuring and planning at a technical tax level is hugely important, the themes that are driving wealth management obviously make a huge difference as well, and spotting those themes in advance. So the first thing I would say is, broadly speaking, to avoid what we call risk assets, in other words, equities, property markets, currencies. Avoid the risk assets of countries who are adopting destructive punishment policies, because they're damaging to the health of those economies and damaging to the asset classes in those economies. You're seeing that in terms of the UK, you see it most obviously in what's happened to the pound, but also to domestically oriented equities in that country. And then, slightly perversely, embrace the risk assets of the unsustainable growth countries. Because whilst at one level, and I've covered it, it's not a good policy to deal with these issues long term, the reality is in the here and now, that does present some good, interesting investment opportunities, such as infrastructure spend in these growth promises. So it's very much, and we've seen it since November, December time in the US, that markets have responded very, very strongly to these kinds of policies, and one has to just simply bear in mind that there's a short-term element to these kinds of trades. And before I hand across to Frank for a round on the opportunities out there today, I thought to put those thoughts into the context of some of the major economies around the world today, it's worth looking at, because basically in a world where there's a sense of anti-globalization and protectionism and isolation emerging, what kind of investments, what kind of portfolios are helpful in that environment? And one would be those who aren't sensitive to exports so much, who aren't reliant on exports so hugely. Another would be countries which are sufficiently competitive that they can actually withstand that kind of environment for whatever reason. It might be that their technology or their products are just must-haves, and they've got that edge that they can compete in any event. And finally, policy settings. What's the interest rate environment like? What is the monetary and fiscal situation like in terms of taxation and so on in countries? And it's an interesting way to look at things, I think. So you can see that the US, for example, is coming out on top there with not just a tick overall, but a couple of ticks, because okay, they've got a reasonable amount of exports going on, but they're not reliant on exports. It's a small export economy. The internal demand is the big driver. Very competitive in terms of innovation, technology. World's leading companies are based there, and the policy settings are favourable. So that's the kind of economy that is favourable to this current environment. Whereas in the UK, again, not an export oriented country, and therefore that's sort of somewhat protected from that kind of environment. But whilst competitive in many ways, there is a bubble there in credit, there's a bubble there in housing, and that could prove quite damaging. And with Brexit and the process that's about to happen there, policy at a policy level is not attractive either. I won't go through all of these, but there are some interesting themes, such as the likes of Germany and Sweden. Certainly they rely hugely on exports, which is not a particularly good thing in that environment, but they are sufficiently competitive to be able to withstand it in our view. So it's not that sort of one strike and you're out, because there are positives there that make these economies very attractive to us as investors, and not least the fact that they've got a very low interest rate environment for the level of how the economy is working at the moment. Spain, again, hugely dependent on exports, but due to deflation has become competitive again. If you look at then some of the emerging markets, India, not really reliant on exports, huge domestic market, not very, very competitive, but what they're doing there in terms of the central bank policy is very supportive. So again, a country that we'd be very keen on. And China is the only one that's quite a mixed bag, and a few question marks thrown in there, because, well, you know, they've always been so reliant on exports, but that's changing a lot with their internal market and the population, the rising middle class there, and they are competitive. So the jury's a bit out on that market. So, and that's really just a quick roundup. I'd like to hand across to Frank to talk a bit more specifically about some of the themes that we're looking at.
Good afternoon, everyone. I know this is the home straight before the lunch, so I plan to try to be succinct and as quick as possible so that you can have a bit of a respite. Thank you, Joe. Very good. When we were putting together the slides for the presentation, I just reminded myself back in June 2011 when we set up the Smith & Williamson operation in Ireland. And I recall a story which I've told many times to my colleagues. When I was doing my induction in London, in Moorgate, after my gardening leave, during breaks I'd get out my little black book, which I advise every member of STEP to have when you change jobs. And you start to make phone calls, and you're hoping when you make those phone calls, people take the call, might remember who you were, might remember, please God, they had a good experience with you, and may even consider doing business with you again. After one induction seminar in London, a guy called me aside and he said, Frank, just a man, we've just completed our internal marketing document, and you were one of the first people to get a read of this. Back in 2011, Smith & Williamson had 2 people in marketing. One, a retired audit partner, and his deputy was a retired tax partner. And both were semi-retired and bored, so the chairman at the time decided to put them in marketing because they were in the firm. And so we were known in the City of London at the time as the largest unknown financial services company. So they produced this document, and I read the document, and I went downstairs to the trading floor, and I got out my little black book, and I started to ring people. And at the end of the day, this partner came over to me, been in the firm over 30 years, 40 years. He said, Frank, he said, I have to say, I've learned things today about the firm I never knew. I'm actually going to include these items in my next presentation. But one thing I'll say to you is, he says, just remember one thing, he says, we're not stockbrokers, we're investment managers. And I said, what's the difference? He said, oh, it's very simple. He says, stockbrokers, they charge commission. Oh. Next morning, back into the office in Moorgate, and I had this one client. I knew if I could get him to move, I'd be in very, very good stead. So I rang him, called him John. John? Yep. Who's that? Frank. Frank who? Frank Brennan, the investment guy? Oh yeah, Frank. I haven't heard from you for a while. Yeah, no, that's it. I've moved jobs actually. I'm working for a company called Smith & Williamson. Smith & Williamson? What are they? I said, we're investment managers. Investment managers? What do they do? I says, we don't charge commission. Hang on there, he says. Mary, do you remember that? Frank. He's going to manage our portfolio for free. Anyway, what I have noticed is that all our competitors, and you probably noticed this as well, have dropped the name stockbroker. Because in the good old days, that was seen as an honourable profession. So everyone now is a wealth manager. Up until recently, I was at a presentation with a very, very famous French fund manager, just the day after, 2 days after, Macron. And during the coffee break, I said to him, so how are you positioning your portfolios within your investment management division? He said, Frank, I'm not into the accent, Frank, we're not investment managers. We are risk managers. I said, what's a risk manager? We manage the macro for the retail investor. I says, how do you do that? We tell them what they want to hear, and we invest the exact opposite. So I have a prediction. Say 2020, Smith & Williamson risk managers, and 2025, Davy risk managers, Goodbody risk managers, Investec risk managers, Merion risk managers, etc., etc., etc. And I suppose if we look at the macro environment, you can see what my French friend was alluding to. And the macro environment, whether you're interested in investment, is particularly tricky. They say, may you live in interesting times, and I suspect when historians look back on this period that we're all living in now, and maybe even our children, our grandchildren, will say, Mum, Dad, what was it like when you could buy a bond and receive a negative return and sell it at a profit? Or what was it like when you could be in an environment where there was no money in the banks, no money in the economy, and how did you manage to survive the worst crisis since the 20s? So these things will be posed and history will be written, and I think at the end of the day, like everything in life, it moves on. And if you look back over the last 2 years, even since the global financial crisis, we have had an unbelievable number of macro events over the last 2 years. Things that we thought could never happen have happened. Meanwhile, the markets have continued to climb this wall of work. So after the technology crash of 2000, we had the recovery into the financial crisis of 2007, and today in 2017, the world equity market, if we look at the MSCI as an example, is trading at an all-time high. However, it doesn't feel like the euphoria we had back in tech, or indeed in 2006, global property bull market. Investors don't feel the euphoria, but markets have continued to climb. If we now look at markets today, it's certainly, on valuation perspective, the US market does look to be trading at a significant premium to the other major markets. So today the US market is trading on about 29 times earnings against its average of about 18. So some of that obviously reflects back to the observations Joe was making. The US economy still dominates the globe. A lot of investors have no alternative but to seek a return on their money and are being forced somewhat uncomfortably to invest in assets that will give them a yield. A lot of those investors are worried because they have memories of what happened previously in 2008. So are using index funds or exchange traded funds to broadly put money at work on the basis that if I put money to work in the spread, I will reduce my risk. Right now, Vanguard, who are the world's biggest index tracking exchange traded provider in the world, currently are investing approximately $2 billion a day into the S&P 500. That needs to find a home and has reflected in current valuations. Meanwhile, traditional safe havens, and this was touched on in earlier presentations, are offering very little return, as we know. Currently, a 10-year US government treasury will broadly give you about 2.3%. The argument being posed to investors is, why would you buy a 10-year US government treasury giving you 2.3% when you can buy Nestle, which will yield you 3.2%, and it's the world's biggest consumer goods company? Of course, if you look at Nestle, which is a super company, you'll discover for the last 5 or 6 years they have struggled to grow their top line earnings. And you could argue that they've used their balance sheet, the strength of their balance sheet, to engineer cash flows in order to sustain dividends. And as Joe alluded to in his presentation, at some stage, the company will have to decide whether it's going to invest for the long term or to keep paying out a dividend that may become unsustainable. If you look at the FTSE 100 right now, the dividend cover on the FTSE 100 right now is at the lowest level in 27 years. Its dividend cover is 1. Our view will be a Glaxo, a Shell, a Diageo will cut its dividend at some stage. And when they do, everyone else will follow. The argument being, why should we be paying out dividends of 3 or 4% when 10-year government bond yields are in some cases half that? Surely we should cut our dividends and use that additional cash to invest for the long term because we're long-term businesses. I suspect when that does happen, share prices will react violently. So going back to my French colleague, risk management. What do you do? Well, unfortunately, we do charge for running portfolios, but we don't get paid for putting money in cash. We need to be very conscious that when people entrust capital, that they expect maybe one day to want that capital back. So a very big primary concern for us always is liquidity. Liquidity, liquidity, liquidity. If you stand back and look at global GDP, it is below trend. So despite central banks pumping the economy with trillions and trillions of cheap free money, the global economy has struggled to grow. And even in the first quarter this year, 2017, the US economy grew by an annualized rate of around 0.7. And this is way off Mr. Trump's target of 3. The US market right now is factoring in a long-term growth rate of approximately 2%. And this is the big dilemma. And this is why people are beginning to question whether some of his policies can ever get implemented. Will he be able to reduce taxes? Will he be able to repatriate cash? Will he be able to do a massive infrastructure stimulus program? We know the key challenges confronting markets. And it goes without saying that right at this moment in time, we are particularly defensively positioned. Joe alluded to the €500 million we have successfully gathered and entrusted to manage for our Irish clients. And the one common theme for every one of those clients, if we had them all in the room now, would be, Frank, for God's sake, if I come looking for the money, I want it back. And secondly, if I've given you €100, I expect to get back at least €100. In fact, if you can make a measly 3 or 4% return, I'll be delighted. That doesn't sound very much, but going back to my bond analogy, if 10-year government bonds are yielding 2%, to get twice that involves a degree of risk. In the good old days, you could just simply buy a German government bond and go off and play golf. Those days are now over. So the policy challenges we face as investors are very, very, very easy to understand. It is the macro. As Joe alluded to, in the good old days, you could ignore the macro. But now the macro is impacting policy decisions by central bankers, which are influencing markets directly. I haven't read The Art of the Deal, and to be honest, I have no intention of buying the book. Someone gives it to me, I'll read it. But the guy mentioned to me that if you want to understand Mr. Trump, you've got to understand how he thinks. And for the lawyers in the room, allegedly in the book, he describes legislation as follows. Legislation is merely a deal to be struck after promises have been bartered. It is our opinion, and I think it's the market's realization, that basically we just simply have to ignore a lot of what the man says. But we can't ignore that he does currently control, indirectly or directly, depending if you believe the Russians, the biggest economy in the world. So, as risk managers, as investment managers, we have to look at where best to place our clients' capital that have entrusted us to manage for medium or long-term objectives. And there's a couple of themes that jump out at us that I don't think are going to change in the short or medium term. The first one, and I think we're beginning to see signs of it, is inflation. It's been our view for quite a period of time, you just can't simply print money and not expect unintended consequences. And we're starting to see wage inflation creep up in the US. That will ultimately lead to higher consumer prices globally. And then central banks are going to be faced with a very difficult choice. Do they let inflation run to effectively erode the legacy debt from the good times, or do they raise interest rates? And if they raise interest rates too quickly, all of us in the room on tracker mortgages are going to be clamoring for increased wages and lower taxes to meet our capital repayments. But inflation as a theme, we think, is now coming back into play. So as part of our portfolios, we would suggest an exposure to inflation-linked bonds issued by both governments and corporates as a way of offering some protection to the purchasing power of your capital. Joe alluded to infrastructure. This is an asset class that we think will remain attractive for many, many years to come. Assets that produce predictable cash flows, perhaps backed by a local government or authority, that need to be in place regardless of recession, boom or bust. Things like toll roads, tunnels, bridges, schools, hospitals. Many of these assets can only be built in public-private partnerships. And if those assets produce predictable cash flows, they can be attractive for investors as a source of yield. And because they're infrastructure assets, they're automatically defensive. Governments will be loath to close hospitals and schools even in times of recession, although it can happen. We obviously look at the whole area of food. Global population growth is rising. People in the emerging world, when they come out of poverty, the first thing they do after they educate their kids is they typically change their diets. And after they change their diets, they start to consume. So we are firm believers that people still have to eat, regardless of Mr. Trump. And we think food is a key part, and exposure to food is a key part of our portfolios. Linked very closely to that is clean water. Only 4% of the world's water is drinkable. Water is a scarce commodity. And in fact, we would argue it will become a key component of sustainability going forward. And again, we think it's a good investment team to look at. Right? Energy security, especially with proposed isolationism and trade wars, trade barriers, very, very important. Whether we like it or not, we're still addicted to fossil fuels, regardless of solar energy, wind farms, etc. Robotics, talked about previously as well. The transfer of wealth from labour to capital will continue regardless. And unfortunately, many of us will ultimately be probably replaced, partially or somewhat, with a robot. I think my wife would like that, especially when it comes to cleaning the kitchen and the like. And last but not least, and we've seen this recently, and this slides were submitted months ago before what happened in the recent days over cybersecurity, but it's quite clear to me that the next world war won't be fought with soldiers in fields. It'll be fought over the internet. And maybe today, the last few days, we've seen signs of that, where you can cause more damage to people by removing sensitive information or capital from their account than trying to invade a country and end up what we currently have in many parts of the world, which is an untold mess. I came across a very good quote recently by an 18th century Swiss mathematician, Jacques Rousseau. Patience is bitter, but its fruit is sweet. And I think that best sums up the investment world at the moment. The macro picture is uncertain, but it's always uncertain. But I think today, because of the rise of so-called populism, people are now questioning a lot of things they never questioned, and that is influencing investor sentiment. But I go back to my French friend. Manage the macro for the individual. Talk about Trump. Oh my God, he's terrible. The fellow in North Korea. What's happening in the Middle East. Brexit. I think if you stand back, one of the biggest issues we all faced very recently was the French elections. There's no question if Le Pen was elected, the EU was over. And Brexit would not be an issue. We would be now fighting for our lives in the breaking up of the EU. That didn't happen. I look positively at that result because I think now what will happen in Germany is that I expect Angela Merkel or her successor will take a slightly different view with regards to the German current account service, and perhaps will decide that austerity may be not the best thing for Europe, and maybe we need to redeploy some of that capital into southern Europe to stem the rise of populism and give everyone the feeling that we're part of a project. On Brexit, my own opinion is that I think Theresa May will get a large